Fine. So let's start. So last time, before the internet went off abruptly, listen, before the internet went off abruptly, you remember, we were discussing what we were calling fair value adjustments. Listen, I am trying to update you first so that we pick it from where we left. So we said that when you have a fair value adjustment, listen, and that the subsidiary company has not, that's what we said, and that the subsidiary company has not incorporated the revaluation. If you remember, let me take you back. Yes, there it is. We say if the subsidiary company, yours, was supposed to revalue in January 2007, I hope you can see, and we were consolidating in 2010 to Kasema, if by January 2007, my subsidiary did not revalue, then to Kasema, when it comes to the year 2010, you as a holding company, you must do some two adjustments. One is what we were calling revaluation adjustment. I have circled it. The second one is what we were calling depreciation adjustment. I remember saying that once you revalue the asset, that revaluation reserve, we said you consider it as a pre-acquisition revaluation reserve, We said you take your share to the cost of control. I hope you can see it up there, and the share of the NCI to NCI. Then we said you do a second adjustment called depreciation adjustment. Find out whether the subsidiary was undercharging or overcharging, whether they were undercharging or overcharging. And I told you, if they were supposed to revalue from 10 to 12, then they were undercharging depreciation. So tukasema, what is the undercharge per annum? I hope you can see within that table or within that graph or within that they were charging 2 million. They were charging 2 million, but had they revalued from 10 to 12.5 to 12, they were supposed to be charging 2.4 million, you remember? So we saw our subsidiary was undercharging depreciation every year by 400, if you remember. Then tukasema, for how long? For 4 years. Then tukapata total undercharge, ikakuja 1.6 million. Total undercharge, ya 1.6 million. Don't forget, we had already discussed the double entry. Listen, we had already discussed the double entry for undercharge. And we had said, when there is an undercharge, you are supposed to debit P&L and credit provision for depreciation with the total undercharge. I hope we had written it somewhere. Let me see. Not there. We had written it somewhere. The double entry. Let me take you to back. I think we had written it somewhere. How to deal with the double. There it is. Turn to Kasema. If there is an undercharge of depreciation, you debit P&L account and you credit provision for depreciation, or you credit what we were calling the asset with the total undercharge. That's what we said. Then from there, we went further and saw that suppose, listen to Kasema, there are two approaches, and that's what we were discussing. There are two approaches of dealing with the depreciation adjustment. One approach to Kasema even, that you as a student, once you are given a question of group balance sheet to do, you can start by splitting all the finances of the subsidiary. Split all of them, whether ordinary, whether retained profit, whether share premium, whether general reserve. Split all the finances that are in the balance sheet of that subsidiary company and transfer them to where they belong. We were saying either they belong to the cost of control or to the non-controlling interest or to the consolidated P&L account. That's what we were saying. Either they belong to either of them. So I can see here what we were trying to establish was when a student took that approach. I can split the ordinary. I hope you can see the 10 million. I can split the profit. I hope you can see the profit of 8 million. Then tukasema profit is normally splitted between pre-acquisition and post-acquisition. That time tuka-assume our pre was 3 million, tukabaki na post as 5 million. Once you split the profit, you normally take your share, you as a holding company, and give the non-controlling interest their share, both for the pre and the post. You normally take your share of the pre and also your share of the post. Give minority or the non-controlling their share of the pre and their share of the pre, yes, and their share of the post. Once you split, tukasema, like for example, I hope you can see, the 5 million called post, we took 80% of it, which came to be 4 million, na tukasema, hiyo inenanga kwa consolidated P&L account as your share of the profit, Then you took 20%, of that post, which was coming to 2 million or 1 million, and you gave it to the non-controlling interest. So once you opened the various accounts called cost of control, I can see it down there, we opened another one called consolidated and NCI. You can see I gave the NCI their share of the post, that is 1 million, and the share of the post from the subsidiary, we gave it to the holding. Listen now. Then we went further and said, once you have splitted the finances and you have transferred them to where they belong, you went to the additional information. Listen, this is one approach one student took. Akaenda kwa additional information. Number one, tukasema, maybe kuna intercompany debt. Akajua he must eliminate. Number two, akasoma, akakuta kuna unrealized profit on closing stock. Aka-eliminate. Number three, akasema, kuna fair value adjustment. Akasoma hiyo fair value adjustment. Akaona this company subsidiary was supposed to revalue from 10 to 12, but they never did it. They were supposed to revalue from 10 to 12, they never did it. Then this student computed the undercharge of depreciation, Akapata the same 1.6 million, the one we have discussed and the one we discussed last time. Then I said, yes, it's true, it's an undercharge. But do I go with the double entry that we wrote? Do I go by the double entry that we wrote? That double entry for undercharge. Yes, we said the undercharge should be debited in the P&L account and credited in the provision for depreciation. But the question is, do we debit P&L account by 1.6 and we credit provision for depreciation by 1.6? I do hope you remember we said no. Why? Because this student went to the P&L account of the subsidiary. Get the point? He went to the P&L account of the subsidiary company. He found their profit as 8 million, which I am circling somewhere. You can see that 8 million. Then he splitted it the way we have done. Then from the additional information, he realized that this profit of the subsidiary company that he splitted, that profit was wrong. What was it supposed to be? That profit is overcasted. Why? Because our subsidiary was undercharging depreciation every year, by how much? By 400. For how long? For 4 years. So to counter, our subsidiary company was under providing depreciation by 1.6 million. They were under providing depreciation by 1.6 million. When the profit, we say when expenses are undercasted, automatically profit is overcasted. When expenses are undercasted, profit is overcasted. So we saw our profit was overcasted by 1.6. Listen. Then we asked ourselves, specifically, which of the two profits of the subsidiary company is wrong? Is it the pre-action profit or is it the post-action profit? We concluded that it must be the post-action profit that is wrong. Why? Because it is after I've acquired my subsidiary company that they went on wrongly depreciating. It is after I've acquired my subsidiary company that they went on wrongly depreciating that asset. So we saw it is our post that is overcasted by 1.6. I can see, can see a red there mark. You can see the red writing. We saw that our subsidiary was overcasted. Their profit called post was overcasted by 1.6. Listen, then we saw we said, but when you as a student, you are doing your workings, which is okay. What did you do? You took 80% of the 5 million, which you got that 4 million, and you gave it to the holding company. Nothing wrong. Then you took 20% of that 5 million, you gave it to the non-controlling interest, which is that 1 million, which is nothing wrong. Then we said, therefore, if the 5 million I splitted was wrong, and it is more by 1.6 million, how do I correct that case? I don't just go to the P&L account, because we said the double entries you debit P&L account. We said you don't now just go to the consolidated. Listen, we said you don't just go to the consolidated P&L account and debit it by 1.6 million. No. Why? Because we said, as much as it's true, I gave the holding company a share of 4 million from S on the credit. Even though I gave them a share of 4 million from that subsidiary company, that 4 million profit of the subsidiary company, we agreed it's not more by 1.6 million. I hope you remember. We said it's not more by 1.6 million. Why? Because we went and said, when we were splitting the 5 million, which was wrong, we gave 80% of it to the holding and 20% of it to the non-controlling. So if anything in the 5 million is wrong, then tukasema, follow where the 5 million went. Follow where the 5 million went and correct it effectively. That 5 million went to two groups of shareholders, to the main shareholder, which is you, the holding company, and to the non-controlling interest. How much of the 5 million which is wrong? It's 1.6 million. So we said, how much of the 6 million, 1.6, sorry, how much of the 1.6 million went to the holding company? Tukasema, listen, anything wrong in the 5 million, 80% of whatever is wrong, 80% of whatever is wrong went to the holding company. So we saw that if 1.6 million is, if the 5 million is overcasted by 1.6 million, what is 80% of that 1.6 million? I gave the holding company 80% of 5 million, which is that 4 million. But I later realized I gave the holding company more than I should have given to them. By how much? Not by 1.6 million, but by 80% of the 1.6, but by 80% of whatever is wrong, which we saw as 12/80. I hope you can see it there, which we saw it as 12/80. Then tukasema, but you also gave the non-controlling shareholders 20% of the 5 million, and yet that 5 million is wrong. So it also means what you gave to the non-controlling interest as their share of the post is also wrong. It is also overcasted, but by how much? By 20% of whatever is wrong. By 20% of whatever is wrong. What is wrong is 1.6 million. So 1.6 million, 20% of that which is wrong, we say that comes to 320. So we say now follow that 5 million, correct it effectively. Go reduce the profit of the holding share. Go reduce their share of the holding by 12/80. Go reduce the share that you gave to the non-controlling interest by 320. And that's what we did when we were doing the double entry. I hope you can now see. We said, yes, I gave the holding company down there a share of 4 million from S Limited. But that 4 million is not more by 1.6 million. It's more by 12/80. So that's why we had to debit consolidated P&L account with the group's share of the non-controlling interest. We also said, but you also gave 20% of 5 million to the non-controlling interest, which you gave them as 1 million. That 1 million is more, but it is more by how much? It's more by 20% of whatever was wrong. What was wrong was 1.6 million. What is 20% of 1.6 million? It came to 320. It came to 320, which I can see we debited. Listen, that automatically now says, listen, that automatically comes to say, if I gave the NCI a share of 1 million initially, now I am debiting them by another 320, then it means effectively I am giving NCI a share of how much from the subsidiary's profit. I am giving NCI a share of how much? Somebody with a calculator. I initially gave them 1 million, but I later realized that 1 million is more by 320. So it means effectively we are giving them how much from? Yes, we are giving them that 680. Good, that's 680. What about the holding company? I gave them an amount of 4 million initially. Then I later realized that 4 million is more than it should be by 1280. It means effectively you are giving the holding company how much from the subsidiary? Somebody with a calculator. What is 4 million minus? That is 2720. Okay, 2720. Now, listen. So that was one approach we discussed. Listen, that if you want to take that approach, listen, when you come to your note number 3, or whichever note additional information the examiner will give you, then we said, in that case, you remember to split whatever is wrong. Why? Because tulisema, anything wrong affecting the profit of the subsidiary company automatically affects two groups of shareholders. That is the holding and the non-controlling interest. Then we said, now to correct it, follow it. Okay, that was one approach. The second one is what we were saying. Let me wrap this now. I don't know whether it was that one. Let me see whether we had another one. Yes, it is here. Sorry. The second one, ndio hii sasa. Now stima ikapotea tukiwa hapa sasa. Now we had said, listen, the second approach. Yes, I've gone to the balance sheet of the subsidiary company. Listen, you as a student, listen, you as a student, you have read the question. Then once you read that question, you realize note number 3 is about fair value. Then you obviously knew that from that fair value, depreciation will be affected. Listen, depreciation being an expense or conclude the profit of the subsidiary obviously must have been affected. So listen, so before you splitted the profit of the subsidiary, which from the balance sheet is 8 million, which the first student had done it, no problem. This other student said, but this 8 million that we are given, in the balance sheet of the subsidiary company is wrong because of note number 3. So this other student decided, why can't I correct the profit of the subsidiary first? Why can't I correct that profit of the subsidiary first? Aka conclude, akasema, this subsidiary was undercharging depreciation every year by 400 for 4 years. Total undercharge, 1.6 million. When expenses are undercasted, profit is overcasted. So this second student decided, why can't I correct the profit first? Of who? Of the subsidiary, not of the group, the profit of the subsidiary company. So akafungua P&L account ya subsidiary. That's where we were. Akafungua P&L account ya subsidiary. He brought down the 8 million. He brought down that 8 million, whatever it is, from their balance sheet. Then the student realized their profit is overcasted by 1.6 million. So this other student akakuja ka debit P&L account of S by 1.6 million, aka credit provision for depreciation, the normal double entry for the undercharge. That when there's an undercharge, you debit P&L account and you credit provision for depreciation. Listen, once this student did that, he got now the true profit. He computed the true profit of the subsidiary company. Somebody with a calculator, if they had a profit of 8 million, but now we realized their profit was overcasted by 1.6 million, the true profit of the subsidiary must have been 6.4. A book confirm? Yes, 6.4 million. Good. 6.4 million. Listen, once you did this, that's another student now. Once you did this now, then you came and now decided, let me split that profit of 6.4 million. Let me split that profit of 6.4 million between, again, pre-acquisition and post-acquisition. You concluded the pre was not wrong, so it still remains 3 million as it was initially. But therefore, it means our share of the post will be 3.4 million. Our pre was not wrong, so it is obvious it is the post that we are now taking. You came and now took 80% of that. You gave the NCI their 20%. So somebody with a calculator, what is 80% of 3.4 million? Somebody with a calculator, what is 80% of 3.4 million? 80% of 3.4 million, somebody is giving me 2720. What about 20%? 20% of 3.4 million? 680. Good. Now listen. Once you did this, now listen. Once you did this, now you transferred these figures to where they belong. One of the accounts you opened was NCI. After giving them everything else, ukakuja ukasema from the post-action profit, I'm giving them their share from the post. I am giving them their 680. Then you open another one called consolidated P&L account. Consolidated P&L account. First, you must have brought in your own, whatever it is. Then you came and said from S Limited, I am entitled to my share, ukule juu ya 2720. Now, listen. The first student we saw, which splitted everything first, splitted everything as they were given in the balance sheet. We can see he gave NCI a share of 1 million. Later, he came and debited NCI by 320. We have agreed. Effectively, therefore, he gave the NCI that amount to the left, which is 680. That first student initially gave the holding company a share of 4 million from the post of the subsidiary. From the post of the subsidiary, he gave the group or the holding company share of 4 million. Then he realized it's wrong and he debited consolidated P&L account by 1280. We have seen again, effectively, he gave the holding company a share of 2720 on the left. That's what the first student did. You, as you are first as a student also, you read the question, you realized that the profit of the subsidiary is wrong. They are 8 million. So you have concluded, because it's wrong, why do I have to split something wrong? Let me correct it first, which is okay. So you corrected that 8 million by debiting P&L account of the subsidiary by 1.6 million, which is the undercharge. Then you credited provision for depreciation. Then you got that 1.6 million. There are 6.4, sorry. It is that 6.4 million, which is the true profit now of the subsidiary company. Then you splitted it accordingly. Once you splitted it accordingly, then you now transferred it to where it belongs. Your share of the post, you took it to the consolidated P&L account. The share of NCI, you took it to the NCI. Now you can see, listen, I hope you have noted. Sorry to interrupt. How did we get 3 million? No, 3 million is something we were assuming, even from the previous class. We were assuming that the pre-action profit the examiner gives you, is 3.4. The pre-action profit. That is something we had agreed from the time we were doing the question the previous class. I hope you can see it there. Let me move it. I hope you can see it there. 3 million is what we were assuming. We were assuming you are given a balance sheet of that subsidiary company. You are given the balance sheet of that subsidiary. From their balance sheet, we were saying you are told their profit is 8 million. Then from an additional information somewhere, you are told as at the date of acquisition, the subsidiary's retained profit was 3 million. If it was the profit as at the date of acquisition, that becomes the pre-DOE. I hope you can see, I am circling it with red, that 3 million called pre. But because this student did not correct the profit, obvious for him, the post was 5 million. The difference. If the profit is 8, out of which 3 million is the pre, then automatically the post will be 5 million. Now listen, this second student concluded, why do I have to split something wrong? Let me correct it first. Aka correct your 8 million. Aka debit P&L account by 8 million. Aka pata 6.4 million. Akasema, let me split the correct profit now. 6.4. Akarudi kwa swali akaangalia, what is their pre-action profit? Akapata 3 million. That's the pre, ndio hiyo. Then akasema, if the pre is 3 million out of 6.4 million, what is the balance? The balance is 3.4 million. That becomes the post-action profit. I hope you're okay now, where we are getting the 3.4 and the 3 million. Already you have said yes. Thank you. Sawa. Now, listen. So I want us to choose one of the approaches that we shall have to be using. I want us to choose. Do we choose the first one? Do we choose the first one where we splitted the 8 million, where we splitted the 8 million, that one? Then we later realize that the post, which was 5 million, was wrong. Then we corrected it by following two areas. Or do we go by the second approach, whereby you realize that whatever is given to you as the profit of the subsidiary is wrong? So Kamua, let me correct it first. So let us choose which of the two approaches we shall adopt, we shall be adopting. Which one do you feel is better? Is it the first one where you split the figures, then later you realize you have split the wrong thing? Listen, if you choose that way, then when it comes to correcting, you must remember to correct two things: what went to the holding and what went to the non-controlling. Alternatively, you can correct the profit first. Then once you correct it, then you know you are splitting the correct thing. Then once you have done that, then there are no complications after that, because you know you are splitting the right thing. So which approach do most people? Because we said we can't be using both. We can't be using both. We have to choose which of the two approaches to use. We have to choose which of the two approaches to use. So which one do you feel is better? First or second? Majority are voting for the second. Majority are voting for the second. So let's now decide that, listen, from now on, any question we shall come across which has a depreciation adjustment because of fair value, we shall be correcting. Listen, we shall be correcting the profit of the subsidiary first. And by the way, it is the most advisable approach. It is the most advisable approach. So andika kwa note somewhere, andika kwa note somewhere, put it down this way, NB note. NB note. NB note. It is advisable that before splitting the profit of the subsidiary company, first adjust it. Before splitting the profit of the subsidiary company, first adjust it by the depreciation adjustment. It is advisable that before splitting the profit of the subsidiary company, first adjust it by the depreciation adjustment. Okay? So that was what was remaining just before our internet connectivity went off. Okay? So I think now we are through. Listen. I am not saying, listen carefully, I am not saying that we shall have always to be debiting P&L account. Get my point? To correct the profit of the subsidiary company, I am not saying we shall always be debiting P&L account. No, it depends whether it is an overcharge or an undercharge. If it was, listen, if it was an undercharge, these guys, no, overcharge, assuming they were to revalue from 10 to 8, and they never did it, from 10 to 8, and they never did it, they will still give you a profit of 8 million in their balance sheet. You will split it as normal, transfer it as normal. Then when you come to note number 3, you realize your subsidiary this time was overcharging. Why? Because they were supposed to revalue from 10 to 8 to 8. They never did it. I hope you remember we also discussed that area. Here it is. Look at this table. We said if they were supposed to revalue from 10 on the left, I am circling it, and they never did it, they were supposed to revalue to 8 pale chini. They went on charging 2 million on the base of 10, but had they revalued from 10 to 8, we saw 8 million divided by this life of 5 years, they were supposed to be charging 1.6 million. So our subsidiary was overcharging depreciation every year, again by how much? By 0.4 million, by 0.4 million. For how long? For 4 years. That came to be again a total overcharge of 1.6 million. So again, before you split the profit, it will be advisable that you correct it. How do you correct this time? With an overcharge. You debit, listen, with an overcharge, you debit provision for depreciation and you credit P&L. You debit provision for depreciation or asset and you credit P&L account. That's what we are saying. If you took the second approach, if you are a student who took the first approach, this one, then you would now argue, follow it now, you will now argue by saying, this 8 million they are giving me is wrong by 1.6. Follow now, by 1.6. That 8 million, is it more than it should be or less than it should be? It is obvious when expenses are overcasted, profit will be undercasted. When expenses are overcasted, profit will be undercasted. When expenses are overcasted, profit is undercasted. By how much? Every year 400 for 4 years, 1.6 million. So our 8 million that they are giving me in the balance sheet, this time will be undercasted. Then you argued and said, but which of the two profits of the subsidiary is wrong? Is it the pre or the post? You concluded it is the post that is also undercasted. Okay, this time it is undercasted. But you took 80% of 5 million, you gave the holding company 4 million. You took 20% of 5 million, you gave the NCI 1 million. Later you realize that what you splitted is less by 1.6 million. So you cannot go now to the consolidated P&L account. Listen, you can now go to the consolidated P&L account and increase that 4 million by 1.6 million. No. Because that 5 million you splitted, it went to 2 members. 4 million went to the holding, 1 million went to the NCI. So if you took this approach and you realize the 5 million was undercasted, follow it where it went. You go and say, what is 80% of 1.6 million? It is 1280. It is 1280. Okay. What is 20% of 1.6 million? It is 320. Now you realize you gave the guys the less, you gave them less than you should have given to them. So go correct now. So you go to your consolidated now, you go to your consolidated P&L account now. This time you now don't debit, this time you credit by another 1280. You now credit by another 1280. Why? Because you gave them less. For the NCI, you initially gave them 1 million, but now you realize you gave them less by another 320, which is 20% of 1.6 million. So you came and added them another 320 there. Okay. Meaning effectively that you have given the non-controlling 1 million. Now you're adding them another. You are now adding them another 320. Therefore, it means effectively you are giving NCI 1320. The holding company, you initially gave them 4 million. Now you are adding them another 1280. It means effectively you are giving them 52 what? You are giving them 5280. But that's what you did. One student did that way. Another student said, why split the wrong amount? Why split the wrong amount? Let me correct it. So this other student, Akasema, let me correct the profit of the subsidiary first. He opened their P&L account, brought down that 8 million. This is for S Limited. Brought down that 8 million. Then he concluded this profit is wrong. It is undercasted. It is undercasted. Why? Because expenses were overcasted. When expenses are overcasted, profit is undercasted. So Akasema, how do I correct this profit? Akasema, with the total overcharge, Let me debit provision for depreciation. Fine. Credit P&L account. So this other student said, let me credit P&L account. Sorry, akakuja akasema hapa depreciation by 1.6 million. Then I can compute the true profit of the subsidiary company, which happens now to be 9.6 million. Then he took this 9.6 million, he splitted it, 9.6. We have agreed, let the post remain the correct one. That is, doesn't change, 3 million. So it, of course, leaves me with the post of 6.6 million. 6.6 million. Then you took your share, you as a holding company, 80%, NCI, you gave them 20%. So somebody with a calculator, what is 80% of 6.6 million? Calculator, somebody. 80% of 6.6 million is how much? 80% of 6.6 million, it looks like 52.80. What about NCI? What is 20% of, this is 52, what is 20% of 6.2? 6.6, that is 13.20. 13.20. Good. So that's what you did. So when you opened NCI, you gave them from the post 13.20. When you opened consolidated, you gave them consolidated P&L account, you gave them that 52.80. Okay. Let's see whether the other student gave them the same. The other student, when he split the wrong amount, this is what he came and did. He came and added them the amount. Holding, aliwapatia 4 million pale chini. Then he added another 12.80. That comes to a total of 52.80, which is exactly the amount we have seen in the other approach. Up there, non-controlling were initially given 1 million as their share. Now you added them another 320. Effectively, you gave them 13.20. That's what we have also seen with the second approach. So both approaches are accepted. You just need to know, is the depreciation undercharge or overcharge? We are saying whether you will debit P&L account of the subsidiary or credit, it depends with either an overcharge or an undercharge question. Good. That means we are through with that item called fair value. And it is a very, very critical item to remember when it comes to consolidation of your balance sheet. You should remember how to deal with it, because that's what we are saying is very many questions have fair value adjustment. But we have agreed it's advisable, not a must. It is advisable that before you split the subsidiary's profit, first correct it with the depreciation adjustment, whether undercharge or overcharge. Correct that profit effectively or correctly, whether undercharge or overcharge. Once you correct it, then go ahead and split that profit. Sour. So we are now through with that fair value adjustment. Now we want to go to another item still under consolidation, and that's what we were calling. You remember when we were listing the items, you need to remember when you are dealing with your section 3 is what we call pre-acquisition dividends. Pre-acquisition dividends. That's what I want to talk about now. It's just a reminder of what you did in section 3. How are you dealing with what you call pre-acquisition dividend? How are you dealing with what we call pre-acquisition dividend? Okay, that's what we want to talk about, just to remind ourselves. But before we do it, let me ask you a few questions. Before we do it, okay, now listen. Now listen. I am introducing, but not pre-acquisition dividend, just concept of dividend. Concept of dividend first. Assuming you as a holding company, you acquired a subsidiary today, 80% shares. You acquired a subsidiary today, 80% shares. Immediately you acquired those shares, your name was registered in the register of shareholders. Listen. In the evening of that day, the company declared a dividend of 10 million. Listen. It is obvious you as a holding company, you will be paid a dividend of 8 million. Listen, whenever a company pays dividends, they pay you dividends as if you have been there for the whole year. It does not matter to the company whether you have been a shareholder for 1 day, 2 days, 1 month, 5 months, and so on. Listen, whenever a company pays dividend, they pay to whoever is registered as a shareholder as at the date of payment. When we are paying, who was a shareholder at that time, that shareholder qualifies to get the dividend for the whole year as if he has been there for the whole year. But that's not my concern for now. I have just said, you have just acquired shares in this subsidiary, your name was registered, then they declared a dividend of 10 million. It is obvious you will be given 8 million. Or in other words, you are entitled to 8 million. The question is this now. You as a holding company, will you take that 8 million as a share of income to you? Yes or no? Will you consider that 8 million as an income? What you are doing in section 3, yes or no? Will you take that 8 million as your income? Yes or no? Will you take that 8 million as your income? Yes or no? Some people are saying yes, some people are saying no. Now listen, listen. We know dividends are paid out of profits. We know dividends are paid out of profits. So the question is this: are they paying us this dividend of 8 million? Am I being paid that 8 million from the profit that the subsidiary made before I acquired them? Or are they paying me this 8 million from the profit they made after I've acquired them? Where are they paying me the dividend from? From the profit made before or after I've acquired? It's obvious. Listen, they are paying me from the profit before, because I've just acquired my subsidiary. Now they are paying dividend. So they are obviously paying me from the profit they made before I acquired. Listen, it is obvious therefore, it is obvious therefore that this subsidiary company is paying you dividend from what we call pre-acquisition profit. The subsidiary is paying you dividend from their pre-acquisition. You know, any profit made by the subsidiary company before the date of acquisition, that profit is considered as pre-acquisition profit. Any profit made by the subsidiary company after you have acquired them, that profit is classified as a post-action profit. Is classified as a post-action profit. Okay? Now, so if this subsidiary paid me dividend from pre-acquisition profit, will I take it as an income, or will I not take it as an income? Listen, today, which is the day you acquired the subsidiary, the day you acquired that subsidiary company, 80% shares, the day you acquired 80% shares, it is from that day, listen, that you should say, remember, you normally invest in companies so that your investment can earn you, an income in the future. You normally invest so that your investment can earn you an income in the future. So we are saying, anything they pay me after I've acquired them, anything they will pay me from the profit they made after I've acquired them, then I can rightfully say I am entitled to that share as an income. Why? Because that's why I'm investing, so that my investment will be entitled to a share of income. But if they are paying me from the profit they made before I acquired them, then I cannot take, listen, I cannot take that 8 million as an income. No. I am being paid dividends from pre-acquisition profit. Listen, suppose to acquire the 80% shares, it costed me 100 million. To buy 80% shares, it costed me 100 million. You know, in the cost of control account, we have always said you normally debit the cost of control with what we call cost of investment. To acquire 80%, what is it that it costed you 100 million? You normally debit the cost of the investment in the cost of control. But listen, today I paid you 100 million. Today you are giving me back a check of 8 million. Today I am giving you, I'm paying you 100 million, but you are giving me back 8 million. Listen, so it automatically means that effectively I did not pay you 100 million. Today I paid you 100 million. Today you are giving me a check of 8 million. Effectively, then I never paid you 100 million. It is obvious I paid you 92 million. Listen now. This 8 million that the subsidiary is paying you from their pre-acquisition profit, that dividend of 8 million is what we shall be calling pre-acquisition dividend. Listen, so by definition, what is pre-action dividend? It is that dividend that is paid out of pre-acquisition profit. It is that dividend that is paid out of pre-action profit. Listen, so that's what it is. Pre-action dividends are dividends paid out of pre-action profit. Listen, then I have also said, you as a holding company, you don't take it as a share of income. Listen, rather, you take it as a return of investment. It's like you are getting back your investment, part of your investment. You paid 100 million, that's the cost of the investment. But you are given back 8 million. That 8 million, you treat it as a return of investment. Listen, as a return of investment. And therefore, it should be credited. It should be credited in the cost of control. To reduce the 100, you credit it. So we are now concluding by saying any pre-acquisition dividend, listen, any pre-acquisition dividend should be credited in the cost of control account. So I have defined what's pre-action dividend. I have also discussed how to treat it. I have said pre-action dividends are dividends paid out of pre-action profit. Then I've said the holding company should not take its share of pre-action dividend as an income. Rather, it should be considered as a return of investment and should therefore be credited in the cost of control. Good. So before we continue, let's put down those key important points. So the subtopic is pre-action dividend. Sam Ivy? Pre-action dividends, pre-acquisition dividends are dividends paid out of. Pre-action dividends are dividends paid out of pre-action profit. Pre-action dividends are dividends paid out of pre-acquisition profit. Full stop. Continue. The holding company should not take its share should not take its share of pre-action dividend. The holding company should not take its share of pre-action dividend as an income. Rather, it should be considered as a return of investment. It should be considered as a return of investment. It should be considered as a return of investment. It should be considered as a return of investment. And should therefore be credited, and should therefore be credited in the cost of control, and should therefore be credited in the cost of control, and should therefore be credited in the cost of control. Another paragraph. The amount to be considered as pre-action dividend, depends with any one of the following situations. The amount to be considered as pre-action dividend depends with any one of the following situations. Okay, now listen. So far, I hope everything is okay in terms of smooth and sound, so that we go monitoring our recording. Is everything okay so far in terms of motion and in terms of sound? Remember, we are recording, so I would want to know so that in future we will be knowing. We have said sometimes when the internet speed is a bit not stable in Asumbuanga, but you have said everything is okay in terms of motion and in terms of motion and in terms of sound. Okay, fine. Now listen now clearly. Now we are saying, how do you determine the amount of pre-action dividend? How to compute it depends with any one of the following situations. Listen now. Some questions might give you a scenario where you, as a holding company, you acquired your subsidiary company. You, as a holding company, you acquired your subsidiary company maybe on 1st July this year. On 1st July this year. That's when you acquired. And come December, by the end of the year, that subsidiary company paid a dividend to their shareholders amounting to 100 million. How do you compute pre-action dividend? I have just told you a short while ago, when a company is paying dividend to their shareholders, they don't care whether you have been there for 6 months or 1 year or whatever. They pay you as if you have been there for the whole year. Listen. So if I acquired my subsidiary on 1st of July and December they are declaring a dividend of 100 million, it is obvious as a holding company, I'll be entitled to 80% of 100. But will I take all that 80 million as my share of income? The answer is no. Why? Because they are paying you for the whole year as if you have been there for the whole year. You have not been there for the whole year. You have only been there for 6 months. So your rightful income, you as a holding company, your rightful income should be for 6 months. But the subsidiary will pay you for the whole year. The subsidiary will pay you for the whole year, that 80 million. Whether you have been there for the whole year or 2 months or 6 months, then they don't care. They pay you as if you have been there for the whole year. So it is obvious, therefore, that part of that 80 they are going to give you, part of it you will treat it as an income, part of it you will treat it as a return on investment. We shall talk about that in a short while. Another scenario the examiner can give you is where, again, you could have acquired your subsidiary company, let's again say, on 1st July. But immediately after you have acquired your subsidiary, maybe on 1st of September, that subsidiary company declared an interim dividend, or in other words, they paid an interim dividend of 100 million. Come the end of the year, they declared a final dividend of maybe another 200 million. So how do you compute your income? How do you compute your return of investment? That's what I want to talk about now. But that's case number 2. The third scenario the examiner can give you is where you could have acquired your subsidiary again on 1st of July this year, I'm assuming. But just before you acquired that subsidiary company, maybe on 1st of May, the subsidiary company paid an interim dividend of another 100 million. But come the end of the year, they declared a final dividend of another 300 million. So how do you compute your income? How do you compute your return of investment? Listen. So whenever the examiner, I hope you're following, whenever the examiner is to test you on pre-action dividend, listen, it will always be one of these 3 cases. Case number one is where only one dividend is paid at the year end. That's number 1. Number 2, where both interim and final dividends are paid. Where both interim and final dividends are paid, but after the date of acquisition. For number 2, I acquired my subsidiary in July, September they paid, final they declared. Okay, that's number 2. The third scenario is where the subsidiary company pays both interim and final. Listen, both interim and final, but interim dividend being paid before the date of acquisition, but interim dividend being paid before the date of acquisition. So how do you deal with that? That's what I want to talk about now. How do you deal with that? So let me go back to number 1. Number 1, I told you, yes, they are declaring dividend of 100 million at the end of the year. Am I a shareholder? Yes, at that time. Controlling what percentage? 80%. What will I be entitled to? I'll be entitled to 80% of that 100 million. Listen, now that they are declaring a dividend, they have declared a dividend of 100 million. Me become a holding company, I am entitled to 80% of 100, which is 80 million. Listen, I am going to debit the account called dividend receivable. They have not paid, but they have declared. So you are entitled to, they have not paid, but they have declared a dividend of 100 million. So you as a holding company, you are entitled to 80% of that. So 80% of 100 million, that comes to 80 million. That 80 million is what you are going to receive. But is that all your income? The answer is no. So how much of that should you as a holding company take to your P&L as an income? To your P&L account, it will be 80% of 100 million for 6 months. Remember, you have been a shareholder for only 6 months, and therefore you are entitled to an income for only 6 months. So 80% of 100 million for 6 months, that is 80% of 100 is 80, half of 80 is 40. So your rightful income is 40. But listen, but you are going to receive 80. So this other 40 they are going to pay you must have been paid must have been paid to you from which profit? From the profit the subsidiary made before you acquired it. So you don't take it as an income. Instead, you take it as a return of investment and take it to the cost of control. So that another balance of 40,000 or 40 million, you will take it to the cost of control and you will credit by another 40. So that's all for case number 1, where only one dividend is paid at the year end, That's how you account or determine the pre-action dividend. That's how you determine pre-action dividend. Number 2, what if I acquired my subsidiary again on 1st July, but immediately after I've acquired them, they paid an interim of 100 million and declared another final dividend of 200 million. So again, come September, I was a shareholder. Come September, I was a shareholder. So I am going to receive, in other words, they will pay me, because they are paying, that interim is already paid. They will pay me 80% of that 100 million. It does not matter, listen, it does not matter that I acquired my subsidiary in July, come 1st September, they paid me. So we can't say that it is for 2 months, July and August, that what you are going to be paid, listen, what you are going to be paid is for July and August. No, I have said dividends are for the whole year. Okay, so you as a holding company, you will debit cash by 80% of that 100, which comes to 80, because they have already paid you 80% of 100 million. Come the end of the year, they have declared another 200 million, which again, you as a holding company, you will be entitled to 80% of that. So you will debit this account called dividend receivable by 80% of another 200 million, which comes to be 160 million, which comes to be 160. Listen, so it means therefore, for the whole year, you are going to receive 240, which is 80 in cash and the receivable of 160. But that's what you are going to get for the whole year, the 240. But I'm not a shareholder for the whole year. I'm only a shareholder for 6 months. But we have said companies pay you as if you have been there for the whole year. So out of that 240, what is my rightful income? To go to the P&L account, listen, you will now come and say 80% of, listen, when I was introducing, I said, when a company pays dividends, they pay for the whole year. Listen, though they paid that 100 million in September, though they paid the 100 million in September, that does not mean, listen, that does not mean that that interim dividend was for January up to August the 31st. No, listen, when they pay an interim dividend, that does not imply that the dividend they are paying in September is for the period of January to end of August. No, listen, it does not matter. Listen, it does not matter when dividends are paid. Dividends are for the whole year, and therefore it should be appropriated for the whole year. It's only that, listen, that this company, instead of paying everything at the end of the year, they decided to reduce their obligation by paying part of that dividend in between the year. They paid part of it in between the year. Otherwise, dividends are for the whole year. It does not matter when they were paid. It does not matter when they were paid. Dividends are for the whole year, and therefore they should be appropriated for the whole year. Whether I was there as a shareholder or not, dividends are for the whole year, and therefore they should be appropriated for the whole year. Listen, so to compute your income for 6 months, because you are a shareholder for 6 months, it will be 80% of, listen, 80% of the year's dividend. The year's dividend. For the whole year, these guys are paying 300 million, which is 100 plus the 200 they are declaring. For 6 months, what is my rightful income? Somebody with a calculator, what is 80% of 300 for 6 months? What is my rightful income? What is my rightful income? 80% of 300 times 6/12. That is somebody giving me 120. 120. Listen. So if your rightful income is 120, But for the whole year, you will be given 240, which was the 80 and the 160. For the whole year, you will be given 240. But now you have concluded, for 6 months that I've controlled my subsidiary, I am entitled to an income. I am entitled. How did we get 300? Listen, 300, we are saying they paid an interim of 100 in September. We are doing case 2. They paid 100 million in September, and they paid another 200, or they declared another 200 at the end of the year. So for the whole year, they are going to pay how much? 300. That's how we are getting. I hope you're okay now. For the whole year, they are going to pay. We are dealing with case 2. Sorry. If you are in case 1, we are dealing with case 2. We are dealing with case 2. Because I said, why are we not debiting cash? Because I said they declared, not that they paid. If they had paid, if they had paid, I would have debited cash. If they had paid. But I said they declared. In other words, they proposed and declared. They declared, not paid. They declared a dividend of 100 million in case 1. Case 2, they paid and declared. They paid 100 million, case 2, and declared a final dividend of 200. So for the whole year, they are going to pay 300. That person who was asking how we arrive at 300, are you okay now? Thanks. Understood. I don't know whether it's the same one. That person who asked how we are getting 300. It is this 100 plus this 200. So for the whole year, my subsidiary paid 300, or they will pay 300. Okay, good. Now, so we are seeing that out of the 240 that you will receive, 120 is your income. So how much is not my income to go to the cost of control? It will be the balance of 120. It will be the balance of 120. Okay? I hope that point number 2, or that case 2, is clear. I have said, though they paid the interim on 1st September, it does not matter when dividends are paid. Dividends are for the whole year, and therefore they should be appropriated for the whole year. That's what I've said. So it doesn't mean that the 100 they are paying is for January to August. No, it is still for the whole year. That's why we are computing our rightful income by considering the dividend paid for the whole year. Good. So we are through with case number 2. Let's go to case 3 now. Case number 3 is where we are assuming the subsidiary company paid. Listen, the subsidiary company paid both interim and final dividend, both interim and final dividend, but interim dividend being paid before the date of acquisition. That case number 3, let's account for it. When they paid an interim on 1st of May, I was not a shareholder. Me as a holding company, I was not a shareholder. So I obviously never received anything out of the 100. But I was there when they were declaring the final one. At the end of the year, they declared another 300,000 or 300 million. I am entitled to my share. So you as a holding company, you will debit the dividend receivable by 80% of 300 million, which happens to be 240. So you are entitled to 240 for the whole year. But will you take 240 as your income? No. You are a shareholder for 6 months only. So you will come and say to the P&L account, you will take 80% of whatever for 6 months. Now somebody tell me clearly, when I'm computing the rightful income for 6 months, I am supposed to take 80% of what times 6/12 for case number 3. I am supposed to take 80% of what? Is it 80% of 300? 80% of 100? 80% of 400? Which one? You must have done this thing in section 3. So utachukua 80% of what for 6 months? Listen. I am just saying you did this in section 3, but listen. But if you have listened to my case 2, you should be able to apply the information in case 2 to answer case 3. You should be able to apply the information in case 2 to give me the answer for case 3. Now think. I have said, applying what I have said for case 2, give me the answer. We're using your information of case 2 to answer case 3. So am I to take 80% of 300? Am I to take 80% of 100? Am I to take 80% of 400? Or am I to take 80% of 200? 80% of what? 80% of 300, somebody says. Another one, 80% of 400, I don't know. 80% of 400, 80% of 300. Oh my. Listen, I have just said, now listen, I am repeating case 2. I have just said, it does not matter when dividends were paid. It does not matter when dividends were paid. I say dividends are for the whole year, and therefore they should be appropriated for the whole year. I also say it does not matter whether I was a shareholder or not at the time they were paying. Dividends are for the whole year, and they should be appropriated for the whole year. So using that information, not case 3, 80% of what now? Using that information, case 3 now. Yes, good. Listen, it will be 80% of the year's dividend. It does not matter whether I was a shareholder or not. Dividends are for the whole year, and therefore they should be appropriated for the whole year. So you take 80% of 300. 80% of 400, sorry, times 6/12, which comes to how much? What is 80%? It doesn't matter whether I was there or not. Dividends are for they were supposed to pay everything at the end of the year after all. It's only that they reduced their burden by paying in between the year. Otherwise, dividends are for the whole year. So that comes to be 160. That's what somebody is giving me. But I'm going to receive a check of 240. But 160 is my rightful income. So to the cost of control, that is how much? To the cost of control, how much? 80. Good. Thank you. So I hope you have understood. Listen, I hope you have understood how to compute pre-action dividend in any one of those 3 cases. Listen carefully. I have also said, if the examiner is to test you on pre-action dividend, it will be one of these 3 cases. Number two, key important point. I hope you have noted in these 3 cases, one common thing. I hope you have noted in these 3 cases, one common thing. I don't want to ask you, but I hope you have noted that in all these 3 cases, I am acquiring a subsidiary in between the year. In between the year. Listen, had I acquired my subsidiary at the beginning, listen, had I acquired my subsidiary at the beginning, then it means everything they are going to pay me is an income. if I acquired my subsidiary in January, whether they pay in June, whether they pay in December, I'll be there for the whole year. Therefore, everything will be my income. If I acquired my subsidiary at the beginning, or I have held it for more than a year, that way, listen, that way, akunanga pre-action dividend. Where you have held your subsidiary for the whole year, meaning you acquired it at the beginning, or you have held it for more than 1 year, listen, akunanga anything the examiner will test you as pre-action dividend. Pre-action dividend only comes in where you acquired your subsidiary in between the year. Listen, so that part of the dividend you will be paid, because you will be paid for the whole year. Some of it will have been paid to you out of the pre-action dividends, out of the pre-action profit, sorry. And part of the dividend will have been paid for you, to you, out of the post-action profit. So it is that difference that brings in the pre-action dividend that goes to the cost of control. Because utakuwa umelipwa dividend out of the profit they made before you acquired it. So you can't take it as your share of income. So in any case, listen carefully. Anytime we shall be doing a question and you realize it is a question where we are acquiring our subsidiary in between the year, listen, the moment I realize the subsidiary has paid a dividend, listen, the moment I realize the subsidiary has paid a dividend, it is automatic that you must compute pre-action dividend. Why? Because you acquired them in between the year, but they are going to pay you for the whole year. Whether both interim or final, it doesn't matter. The key is, when did I acquire in between the year? Are they paying a dividend? 1 or 2, it doesn't matter. Doesn't matter whether both interim or final only, it doesn't matter. You must compute pre-acquisition dividend. Okay? So let's put down the 3 scenarios now. I say it in our notes, depending on any one of the following situations. So andika hivi, number 1. I saw it depending on any one of the following situations. Number 1. Sema hivi, number 1, where only one dividend is paid, at the year end. Where only one dividend is paid at the year end. Number 2, where both interim and final dividends, are paid after, where both interim and final dividends are paid after the date of acquisition. After the date of acquisition. Number 3, where both interim and final dividends are paid, but interim dividends being paid before, the date of acquisition. But interim dividend being paid before the date of acquisition. Okay. Now, having listed them, let's go back to each one of them. Andika case 1, hapo chini again. Andika case 1. Call it where only one dividend is paid at the year end. Andika case 1, where only one dividend is paid at the year end. Where only one dividend is paid at the year end. Where only one dividend is paid at the year end. Where only one dividend is paid at the year end. Where only one dividend is paid at the year end. Sawa. Okay, now let's continue. Now, for that one, or for those three cases, I want us to put down the notes, but in terms of an illustration. So, andika hapo chini, illustration. Then say this, H Limited, andika hivi, H Limited acquired 80% shares. H Limited acquired 80% shares in S Limited. On 1st of October. On 1st October 2020. On 1st October 2020. Full stop. S declared a dividend. S declared a dividend of shillings 400,000. S declared a dividend of shillings 400,000 on 31st December 2020. S declared a dividend of 400,000 on 31st December 2020. Another paragraph. Show the calculation and the recording. Show the calculation and the recording of the pre-acquisition dividend. Show the calculation and the recording of the pre-acquisition dividends. Good. So what you can do, you can sketch again. You can sketch. We have agreed you acquired your subsidiary on 1st October. But they declared a dividend of 400,000 by December. So we want to know, what is my rightful income? We have agreed uta debit dividend receivable by what? 80%. Maybe I could put it at the below. Let me put it here. Uta debit dividend receivable 80% of 400. That comes to 320,000. Then utasema, what is my rightful income? To the P&L account, it would be 80% of, tumesema, the year's dividend, 400, for how many months? For how many months? 3 months. That is October, November, and December. 3 months. So somebody with a calculator, give me the rightful income now. What is your rightful income? What's my rightful income? I'm waiting. 80,000. Sawa, 80,000. So how much am I being paid from the pre-action profit to go to the cost of control? To go to the cost of control, 240. Good. Sawa. Hiyo imeisha. Hiyo imeisha. So let's go to case number 2 now. So we have illustrated a case 1. So finish. We go to case number 2 now. Andika case 2. Where both interim and final dividends are paid. Where both interim and final dividends are paid after the date of acquisition. Where both interim and final dividends are paid after the date of acquisition. Okay. Again, illustration. Sema hivi, H Limited acquired H Limited acquired 80% shares in S Limited. H Limited acquired 80% shares in S Limited on 1st September. On 1st September 2020. On 1st September 2020. Okay. Full stop. S Limited paid an interim dividend. S Limited paid an interim dividend of 200,000 on 1st October. On 1st October 2020. S Limited paid an interim dividend of 200,000 on 1st October 2020 and declared a final dividend of 400,000 on 31st December 2020 and declared a final dividend of 400,000 on 31st December 2020. Full stop. Show the calculation and the recording. Show the calculation and the recording. Show the calculation and the recording of the pre-acquisition dividend. Show the calculation and the recording of the pre-acquisition dividend. Okay, so let's catch again. You acquired your subsidiary on 1st September. Come October, they paid an interim of 200 and declared a final one of 400,000. So we want to know what is your rightful income, what is not your rightful income. We have said you were there when they were paying the 200 interim on 1st October. Debit cash, 80% of 200,000. You were there when they were declaring that dividend or when they were paying interim. So we were given a check. You debit bank or you debit cash. That it comes to 160. I was also there when they were declaring the final. So I debit dividend receivable by 80% of 400. That comes to 320. This is 80%. (80% of 400). That is 320. So for the whole year, I'm receiving 480, 160 plus 320. But what's my rightful income? To go to the P&L account, we have said it's 80%. We have said it is 80% of the year's dividend. It does not matter whether I was there or not there. I say dividends are for the whole year. So for the whole year, these guys paid 600. Multiply that by how many months? Multiply that by how many months? Four months. Okay. So what is your rightful income for 4 months? From September, October, November, and December, those are 4 months. So what is your rightful income? $160. So it means what do you take to the cost of control? That is not your income. 480 is the total that you receive, out of which 160 is your income. That leaves me with another 320, if I'm right. That leaves me with another 320 to go to the cost of control. Good. So I'm through with case number 2. I am through with case number 2. So finish. We go to case number 3 now. So finish. We go to case number 3. Okay. Andika case 3. Sema hivi, where both interim. Case 3, where both interim and final dividends are paid. Where both interim and final dividends are paid, but where both interim and final dividends are paid, but interim dividend being paid, but interim dividend being paid before, but interim dividend being paid before the date of acquisition, but interim dividend being paid before the date of acquisition. Good. So let's have an illustration again. Illustration. H Limited acquired 80% shares in S Limited. H Limited acquired 80% shares in S Limited on 1st of July 2020. On 1st July 2020. Full stop. S Limited paid an interim dividend of 100,000. S Limited paid an interim dividend of 100,000 on 1st May 2020. On 1st May 2020. And declared a final dividend of shillings 400,000 and declared a final dividend of shillings 400,000 on 31st December 2020 and declared a final dividend of shillings 400,000 on 31st December 2020. Full stop. Show the calculation and the recording. Show the calculation and the recording of the pre-acquisition dividend. Show the calculation and the recording of the pre-acquisition dividends. Show the calculation and the recording of the pre-acquisition dividends. Okay. So let's do that now. Again, you can sketch. We acquired our subsidiary on 1st July. Somewhere before we acquired them, they paid an interim of 100,000. Then we are told by the end of the year, they declared a final dividend of 400,000. So what is our rightful income? What is not our rightful income? Okay. We have agreed. I was not there when they were paying that interim. So I never received anything as a holding company. I never received anything out of that 100 as a holding company. But I was there when they were declaring the final dividend. So you as a holding company, you will debit dividend receivable by 80% of 400,000, which happens to be 320. But we want to know what's your rightful income out of that 320, because you are going to be paid for the whole year. as if you have been there for the whole year. You have not been there for the whole year. Therefore, what's your rightful income? So to the P&L account, it will be 80%. We have said, so that I don't repeat again asking you, we have said dividends are for the whole year, and therefore they should be appropriated. They should be appropriated for the whole year. So we have agreed a short while ago, you take the whole year's dividend, which is 500, not 600, sorry, that is 500. So 80% of 500, multiply that by 6/12. I acquired my subsidiary on 1st of July. Somebody with a calculator, what is my rightful income now? %80 of 500, that's 400 plus times 6/12, that's 200. This is 1,000, sorry. We can put it in 1,000. This is 200,000. Therefore, we come and say to the P&L account, to the cost of control, you have an item of 120,000 that is not your income. That is not your income. That's what you will take to the cost of control. So I hope you have understood how to compute any pre-action dividend. We have given the conditions. When will the examiner test you? Only where you have acquired, that's what I said, only where you have acquired your subsidiary, you as a holding company, where you have acquired your subsidiary in between the year. 2, only when they have paid either an interim or final or both. So long as they have paid a dividend, it does not matter whether interim or final, whether I was there or not, you must compute pre-action dividend. You must compute pre-acquisition dividend. So that brings me to the end of that item called pre-action dividend. You should be a bit careful on when and how to compute it, not just any question. Cost of control of the second. Which second one? Second case. Your cost of control is 320. Don't confuse. Ukasema hii 320 ndio inafanana na hii ingine ati zinachukuana. No. Don't confuse those two. It's just by coincidence. Don't always assume it's always the same. No. This is just by coincidence. It's just by coincidence that in total you are receiving for 80. 160 plus 320. That's for 80. Debit. But the credit income is 160. The credit income is 160. So out of 480, the balance is 320, not as an income. Sawa. So don't confuse and say that whatever is the dividend receivable becomes also the pre-action dividend. No. In the other case, it was not the same when I was doing the illustration. When I'm putting the notes, it happens because of the figures. Okay? Sawa. Now, so I'm through with pre-action dividend. Listen, we have no time to start the next item, which we shall do tomorrow. And that's what we call intercompany sale of fixed assets. Another critical area in your group questions. Intercompany sale of fixed assets is very critical. It also is a bit more involving than fair value. It's more involving than fair value. Though the concepts are almost the same, but intercompany sale of fixed assets is more involving than fair value. So that's what we shall do tomorrow. So maybe we can stop there because we can't start and complete anything now. There are some people who say they are joining another class elsewhere, whatever they are doing elsewhere. That is, I think some people are saying they are doing FM. No problem. We can now allow them to continue. But of course, it has been cancelled. Sasa nyinyi ni aje? Sasa tafadhali ningeenda mahali nilikuwa nataka kwenda before 8. Ruth, you are saying it has been cancelled. my. Sasa kwa group unanyona teta, it's not fair that we are putting a class, and we agreed yesterday at about 7:30. When people are saying, oh, we have FM. Let's stop there. I cannot continue, Nani. I cannot continue. Yes. I cannot continue. Yeah. Tomorrow is a day. It's true. Tomorrow is a day. It's okay. We had planned. But listen, Sasa, listen. It means, now listen. It means our to FM, we shall not be taking care of them next time. Once we fix a class as a makeup and we agree, because you're also not sure what's happening. So once we fix a class, yes, because now listen, we have been unfair to 1 or 2 people in the group. Because yeye anasema anajua it was true, it was free at 8. So next time, before we listen to the FM students, we shall have considered. Sawa. I'm not going to say we are not going to consider you. It will be unfair. It will be unfair. Ni sawa. But now, not really unfair. Okay, sawa. Tungesoma tu yetu kuanzia tu saa 2 vizuri polepole paka saa 4 tukule tulale. Sawa. See you then. See you. Let me stop there. Bless you. Good night. Bye. So I'm hoping everything was okay. You have said I think you have said everything was okay in terms of sound and motion. In terms of sound and motion, everything was okay. Very okay, sir. Sawa. Good night. See you tomorrow for another critical area. See you then. Bye. Yes, mine was okay.